Number one, two, and three here, as you mentioned, these are some of my favorites. Just to uh, give a little description here. Number one is the US NFPs, which were not devastating disappointment, but definitely a disappointing result, on line with the trend of a slowing hiring market. Number two is the Shanghai Cooperation Organization Summit last week. I know a lot of you probably on your social media feeds saw the video and imagery of the military parade marching in unison. I don't know um, if I've seen troops marching in that type of alignment and to that degree of precision since maybe World War II or World War I type of era. Kind of calls back to memory. And then in that pipeline there is this, an image too, is this Power of Siberia 2 pipeline, which we'll get into discussions a little bit. That was an agreement signed between Russia and China coming out of the Tianjin SCO summit. And then number three is this segment I've called the French Catalyst with President Macron, in the hallmark of French culture is their hot cuisine, right? But he's the chef here in a situation where the searing flames on the pan are getting pretty intense and the boiling water is starting to uh, turn over. So we've got a situation developing in France. Started a couple of weeks ago with a no confidence vote lining up. I think that vote's actually going to be potentially held today. We'll talk about that as our third segment and what that means for kind of a linchpin and narrative on how things could progress on the key regional front that is Europe. So we'll just hop right in. Cameron, why don't we talk about NFPs first? So Friday,
Looks going.
Friday morning, we got a little bit of a shock result, and it wasn't even the numerical print. It was Howard Lutnick going on the airwaves. I think it was CNBC or maybe Bloomberg he was on, but he said, at first open, these come up at 6 a.m. on the West Coast, 9 a.m. Roughly on the East Coast. This non-farm payrolls report comes out ahead of market open, and if you all recall, last month after the reporting result, President Trump fired the head of the BLS, which is the government agency or bureaucracy that prints these jobs reports. So the first one out the gate, it looked like there might be a data issue, or the surprise might be, hey, we get delayed results or don't even get a result to for markets to trade on and digest. That wasn't quite it. After a little, just a very slight delay, the numbers came out and we, processed those results as we have been doing. So the jobs report, what this is for August, the number was basically on trend. If you look at the results, we've been in a slowing jobs growth market in the U.S. economy basically since 21, 22, when the cycle peaked coming out of the massive monetary and fiscal stimulus that came out of COVID and the following legislative acts and spending coming out of the federal government. But this report was essentially on trend. It was a significant miss. The survey expectations were for 75,000 jobs to be added in August. This report came back with a 22,000 jobs actual, which is really the estimate. As everybody's learning, these numbers get revised over time, and often over the course of months, quarters, years. They go back in hindsight to update the model, the jobs they thought they were getting. These aren't. Um, we're used to a world with internet measurement, right? Clicks, impressions, all of that. The advertising world Cameron and I came from in the 2010s and building out, and every internet-based or mobile app is basically doing the same thing on accurate counting of metrics as everything's logged in a database. It's not the way these old school industrial numbers from kind of the World War II era, or a prior time are being printed. These are coming off of a model estimate out of economists' offices based in Washington, D.C. So the model this month didn't have the massive adjustments we've seen in prior months, basically taking away job growth in the past that was reported to be there, but come as we come back and reassess, the BLS says those jobs were actually not created. This month wasn't quite that; it was more of just a front end miss for the first print. And I think the key takeaway, I've highlighted the box in yellow, but basically every sector except for three, and the two core contributors we'll talk about in a second, but basically every sector is now in job contraction. You saw actual, like, what's the opposite of job growth? Like job losses coming from every sector that wasn't the bright green, which is education and health services, and then purple, which is leisure and hospitality, and then the yellow here is actually up here, corresponding to 12, it's other services. So just the light services industry, could be professional, could be anything. The other services, if you go back in time, it's not that big of a contributor in terms of overall jobs growth. If you look back on the trailing years, you see this, the green box, the education and health services is the core driver of job growth in the US economy. And after that, it's leisure and hospitality, which is everything from hotels, travel, restaurants, et cetera. So that's what this report is basically showing. The core strength of the US economy, the job growth, it is coming from those basic sectors. Health services, obviously, with the demographic situation in the US, what we all know it is with the boomer population impulse starting in the 1950s, 60s, working its way through. Now those people are aging in retirement. On the very oldest, they may be requiring more health care, nursing homes, assisted living facilities. That's one key driver of job growth. And then on the other side, it's education, front end, preschool, middle school, high school, secondary education, all of the above. But that's basically where the jobs live in the US. And then you throw in the hospitality, restaurant industry. That's what's keeping job growth afloat. If you're net new looking for a job, this is kind of where the entry level starts. But the key thing I think in this report is the slowing trend. If you just extrapolate this, if you were running a trend line, it's very clearly down and to the right, which kind of jibes with we'll talk about the business cycle playing out and how this corresponds into asset prices in a second, as the kind of the back half of this segment will work to do some education and explain what's going on in bond markets as they incorporate this read on that the economic data is providing on the U.S. economy. And then prior to Friday's release of the August non-farm payrolls number, earlier in the week, Tuesday, after everybody got back from Labor Day vacation, we got the JOLTS job openings data that the Bureau of Labor Statistics also produces, which is kind of a brother sister of this non-farm payrolls report. What the non-farm payrolls report shows is new job creation. What the JOLTS number shows is job capacity in the U.S. economy by the businesses and government sector of the economy who use labor as an input resource. So what this number shows, it's kind of the think about a stock and a flow, right? This is a stock. It's basically measuring demand for labor, right? How many jobs are there out there that businesses and government are looking to hire for, versus the payrolls report, the monthly NFP print. That's telling you the flow. It's rate of change on jobs added or lost against that stock of job openings by the private sector and government that they're looking to fill. And what this number showed, again, for JOLTS, is kind of lining up. I'll explain how this is a good read on the cycle. I'll pull a textbook out of the mothballs that I think does a good job at establishing this framework. But what the JOLTS number showed was 7.18, roughly, about 7.2 million jobs, outstanding vacancies that exist in basically U.S. employer and government demand. And that was a miss from the survey, which expected about 7.38 or 7.4 million. So what this shows is basically a slowing of jobs, unfilled vacancies. Like there's less demand for labor as an input for businesses. And what does that mean? We'll get into that in a second. Um, and then finally, for how this meets, how the rubber meets the road in terms of impact on asset prices, which the key one here, that is the core driver, is the bond market. Treasuries are responding to this with a strong bid. And what we mean, bond prices are being bid up in this environment in reaction to both the JOLTS print last Tuesday as well as the non-farm payrolls result on Friday. It's continuing into Monday morning. U.S. Treasuries are catching a bid, which means higher bond prices, lower yields. So if you look back on the chart, really going back to Q3, Q4 of 2023, where the 10-year tested 5%. We've been in what I would consider a very quiet, looks almost horizontal, but it is, if you ask me from a technicals perspective, it is downward sloping, um, uh, lower highs and lower lows on the aggregate for the 10-year Treasury. I put some markers here. This yellow bar here, basically going out to this first or this higher high to begin the year in the 10-year back in January. This is basically the Trump administration's tenure. Now almost three quarters in the books. If you look at the track record for the 10-year Treasury, it really is, in my perspective, it looks bullish to me. Yields are trending down with lower highs, lower lows in terms of yield over the time frame that this administration has been in office, which is really being driven at the top from the direction of Treasury Secretary Scott Bessent. If you remember, going into his commentary back in January, February, he talked about we want to be assessed by the results on the 10-year yields. And, by all measures, after three quarters here, the verdict really is showing success by that metric. 10-year yields are trending down. And this really juxtaposes with what's going on in the rest of the world. European sovereign debt rates are actually trending up on the course of the year, as is Japan. So that's a key data point I'd call out. Now, in terms of the bigger lower low on the cycle that still needs to be breached, which despite this rally that we've seen in bond yields or U.S. Treasury yields, this lower low achieved at the end of last September when we got the growth scare and we got the first rate cuts of this cycle by the Federal Reserve at the September meeting of 2024. That low on the 10-year is still about 3.63%. We're at, as of about an hour ago where I took this screenshot, we're at about 4.06. So there's still room to go for this to really continue the overall downward trend of the cycle that's been underway since September of 2023. But as far as this administration delivering on what they said they would do, or what they would focus on and want to be judged on for whether they've been successful or not in meeting their objectives, the results are kind of lining up 3 months or three quarters in.
That makes sense. One question for you, Matt, on this is, you point out that lower low in your mind. Is that an expectation from the Trump admin that they want to get to that lower low point, or is that more of like a, looking at the broader picture, you're expecting to see that lower low be approached or maybe even breached on the lower side?
I would expect in a market you follow a trend. Trend to me looks like bond yields want to come in. That doesn't mean it's risk off. Bond prices up can be synonymous with risk assets like equities, gold. Gold is not a risk asset. Equities and Bitcoin, stuff like that, going up. When I say gold is not a risk asset, it's not trading in this cycle like a risk asset. Didn't have a segment here on gold, but with the gold breakout this week, that is a key point to note. But from what I would expect as a trader, if you're looking at this chart, looking back on the long term, 12 to 24 months, it looks like interest rates want to come down. I would trend with still call it a primary direction on the last 2 years, even though longer term, if you go back to 2020 to 2023, it looks like the trend is up. This trend right now, where we're on the last 2 years, is clearly down in yields. Bonds are catching a bid. There is a move into treasuries. I'll go into some background on this old textbook that can give some mental models to understand why that may be happening. But my default assumption right now is just follow the market. Bond yields want to come in, lean into that. If you try to go into against direction of trend, you're asking for pain. And for all the bond bears out there who were correctly calling the problems, structurally embedded in the U.S. government's fiscal situation, that ZERP, QE, et cetera, were failing, not going to work, coming out of the COVID policies. Definitely were right, especially on the big bear move in yields from 2020 to September of 2023. But over the last 2 years, it's been the opposite. So this could be an intermediate kind of bid down, and maybe eventually yields do start moving higher. That looks for right now to be well off into the future, which means multiple quarters, potentially years away. But right now, I would assume just follow primary trend, and that appears to be down. And defining primary as like a 1 to 2 year, backward looking kind of window.
No, that helps kind of put that in perspective too. So let's kind of shift over to this textbook you've mentioned. Last week you kind of briefed me on this a little bit. It looks like you're going to have a bank balance sheet here. So maybe walk through this, and I think that's going to set our viewers up for kind of the full explanation right after that.
Yep. So I'm gonna walk everybody briefly through kind of the hypothesis, the liquidity theory of money and asset prices, which was a challenger to the EMH, the efficient market hypothesis. Pre-existed the EMH, which really started showing up in the 80s, and just kind of embedded to dominate the academic and industry of financial practice for the last 30, 40 years. But I'll go through the liquidity theory of money just briefly, some highlights from this book by Gordon Pepper. I'll do a quick author review here in a second, but I'll explain what's going on. But first, I want to go through what's going on in the U.S. commercial banking system this year. What does the trend show? And that'll kind of give some light and some or shed some light and background on what we're observing in financial markets to hopefully make these underlying trends make more sense. So give the audience a bit of a mental model to start filling in the lattice work and understanding what's going on, both with the economy and financial markets and how they're related. So first, this is coming from the Fed's H.8 report. You've heard us talk, Cameron and I talk about this in the past on weekly episodes. This is something we track every week. Basically, the U.S. banking system, every regulated commercial bank submits a report up to their regulator at the end of the week that provides a balance sheet snapshot of all their holdings, both assets and liabilities, and reports that into their Federal Reserve regional branch, which then aggregates up into this kind of global H.8 report, which provides a balance sheet snapshot of the US banking system on a 2 week delay. So, right now, the most recent data point we have was for August 27th, and that number came out Friday, September 5th. No one covers this thing to the same degree that in the headlines and in the market reaction, like that the non-farm payrolls report or some other data print such as that would get in terms of impact or attention. But this one is just as important in terms of financial market response, in my opinion, just from the monetary aspect and liquidity framework. So, a couple of highlights I make here. I've highlighted some red boxes across with the key snapshots, in my opinion, of that explain what's going on in the economy on a year-to-date framework or backward-looking 1 year framework. So, looking back, say, to the August 21st of 2024 weekly snapshot of this same report. And basically, what we see is kind of locking in on core trends. So, first off, from the asset side of the balance sheet, there's two things going on. I'll start off with first, it's the actual what's going on in credit creation from a monetary standpoint. This is where the money in the economy is actually created. It's not the Fed doing QE or lowering the Fed funds rate, something like that. It's actually our banks lending. Are they expanding their balance sheet? Are they extending credit into the real economy? Which would in this situation mean households and businesses. We'll talk about the government sector later. They're special unto themselves. But what we've kind of locked in on trend, and what I do here is I annualize the rate of change. So what this means here, if you see this number, the top row, consumer loans is 0.3, 0.1, 0.4, et cetera, or other loans 1.5%, 1.3, 1.5%. What that is that's the rate of change on balance sheet expansion or contraction, if that number is negative, in percentage terms, or if you converted this into bips, we could talk about it in that framework, which makes a bit more sense. But basically, this is the contribution to that balance sheet expansion coming from the U.S. commercial bank system. So what we're seeing, if you look at these two numbers and you add them up, this is where the real growth is happening, or just action whatsoever is happening in loans and leases, or just bank credit creation into the real economy. And this is where money actually shows up in the private sector. So what we're getting essentially over the last year is 150 to 250 bips of growth contribution from these two classes as the driver, which is coming from consumer loans, which would be kind of categorized. Like you can look at the reporting prints here, but it's not real estate. Real estate is in these top two buckets over here. That's essentially flat. It's not a commercial, industrial, or business loan. It's real. The growth is really coming from consumer, which would be potentially credit cards or what would you call it? Just like auto loans, just financing consumer purchases, or the other loans. We've talked about this in before. This can be non-bank lending. So there's a long list of everything that goes in here. Private credit, like it's a laundry list of credit extension. But these two segments are really where the monetary creation has been happening on the 1 year look back in the economy. Won't really touch on it that much there, but maybe we'll talk about this trend in future weeks. Now, where even larger growth or contraction in some case, I'll talk about what's contracting here, is actually on this what I'd call the public sector and bank finance kind of segment of the asset side of the balance sheet. You're starting to lock in a very clear pattern here over the trailing year. If you follow the Treasury securities line item, starting off at 1.2% annualized rate of change, starting in August of 2024, that number is accelerating. It's very clear in the data here. There's an impulse that's taking place. Um, End of July, we were at 3.5% contribution, or 4 point, maxing out at 4.1% annualized rate of change at July 30th. Early August, we were at 4.5. If we really looked in on the look back windows of 2 weeks and 1 weeks, it's even accelerating even further to 6.3% and like 13.4%. So this ramp up in Treasury holdings on bank balance sheets is, you can see it very clearly in the data. It's going, it's increasing and increasing at an accelerating rate. So first derivative positive, second derivative positive, and people who like to speak in calculus terms. Um, so that's something core to going on. Remember that. Hold that thought, put it in the back of your mind, and we'll talk about it here as we walk through Gordon Pepper's money, credit, and asset prices framework to understand what may be going on. And then cash assets. So this isn't necessarily just the Federal Reserve notes, the dollar bills that are trading hands in the real economy or sitting in bank ATMs. Um, it could also be, and the primary share of this line item is actually the cash reserves that the Feds, or that the banks are holding at their regional Fed branch as basically the inside money to settle within the financial system. So when you conduct a wire transaction and you send money to a recipient at another bank, this is the layer that essentially cash kind of transacts with each other. So you can see on that line item, as the Treasury's number is going up, this cash assets line is going down on not quite exactly the same amounts, but very similar amounts. So they're offsetting, not at 100%. So you can see on the 1 year look back window, cash assets are now contracting roughly 70 basis points. And you see that number start to accelerate. The shorter term, you tighten up that window. So you can see cash balance is starting to taper off. If you roll the tape back to 3 months ago, they are cash reserves are declining at about 120 basis points per year. Once you get into July, in terms of like a 5 week look back window or a 4 week look back window, they're not cash reserves are shrinking at about a over 500 basis points per year run rate, and that's the contribution to balance sheet growth. So that would be the effect they're having on bank balance sheets in aggregate. And then you see in the trailing 2 weeks or 1 week look back window, it's accelerating. If these rates would be sustained, it would effectively amount to a cash contribution to balance sheet growth of almost 10 percentage points, or like 1,000 basis points in terms of shrinkage, which, in my opinion, probably not sustainable. So what this is telling you is, as the commercial banks are buying US Treasuries in size, they're funding a heavy share of that out of their cash reserves. So it's literally taking money away from, it's a balance sheet transformation, if you will, to a large degree, essentially shifting assets from cash into U.S. Treasuries. And what does that necessarily mean? Well, if you park money at the Fed, you're going to earn. You can lend it out, and it's actually not Fed funds. Fed funds would be this other line item. If you park money at the Fed, you're going to earn the interest rate on excess reserves. As far as I know right now, the required reserves rate is still zero coming out of COVID. I need to double check on that. But basically, your cash parked at the Fed, you'll get paid essentially something like the money market rate, which is roughly that Fed funds window where it stands at every meeting. You see it in the monetary policy discussion points. There's a line item there. The Fed adjusts this number, the interest on excess reserves rate, which is somewhere in that roughly the midpoint of the Fed funds target range. So you can see what banks are doing is they're pulling um, uh, uh, capital allocation on their balance sheets away from those reserves, and they're moving it into treasury. So if you think about it, what they're doing is they're extending from a zero duration asset to a treasury with duration on it. They're extending out their duration is what they're practically doing. And then the kind of the net of that, if you want to think about it, the difference between uh, the growth in treasuries and the growth rate in cash assets, that the difference is showing up in trading assets. So if you think about it, we learned this in the headlines during the March of 2023 kind of mini banking crisis, the Silicon Valley Bank, Credit Suisse, et cetera. Remember the difference between held to maturity and available for sale. Difference is how the bank elects from an accounting treatment to classify the asset and its reporting. If you do held for maturity, you can mark it at cost and maybe amortize a little way through, but you don't have to adjust that holding on your balance sheet on mark to market results from month to month or quarter to quarter in your reporting versus if you classify an asset, whether it's a loan or a fixed income security, et cetera, as a trading asset, you have to you may or may not hedge it, but you have to pull through the mark to market in your accounting results. So you can basically see the difference here. Some of the cash funding is going into treasury securities held to maturity, and then some is going into treasury asset or trading assets. So you would expect some of that asset shift that's taking place on banks' balance sheets. Some of it may be going into inventory that they intend to move off balance sheet. Some of it is inventory they intend to hold literally to maturity for long-term holdings. Any questions so far,
So
Cameron?
far this is a big deep dive. So viewers, stay with us here, but it is, I think, important to understand kind of the full picture. But yeah, this has been pretty clear to me so far.
So we've established what's happening, right? Banks are ramping up treasuries, and they're shifting duration from cash, which is essentially zero, or reserves parked at their Fed regional branch, and they're extending it into treasuries in size. And this is what's going on with balance sheet expansion. And this kind of really will help us understand what's going on at this point in the cycle. Now, that's the asset side. From the liability side, you have to fund this balance sheet expansion. And two trends I'll point out on the liability side. Over the trailing year, we've seen the contribution of the balance sheet expansion really taper off in terms of the contribution that's coming from deposits, right? And this is your demand deposits parked in the US commercial banking system, which really shows up in this other deposits line item. If you look August of 2024, that number, the contribution to the growth was 2.8%, which was basically what that's saying is deposit growth was doing a lot of the heavy lifting in terms of funding. Those trends we talked about that we've been seeing in money and credit that are realizing or materializing on the asset side of banks' balance sheets. What we're seeing here from other deposits is the contribution from deposits has really dropped off remarkably in August and September. So we've petered off into 0.4%, 0.3% type of contributions in late July or early August. And then the numbers on a 2 week and 1 week look back window they're volatile, they're noisy, and taking a first derivative on the shorter the number, that maybe the more unstable your measurement will get. But it's starting to show this clear trend that deposit growth is tapering off and slowing down. We'll get into what that means in the review of Gordon Pepper's framework here in a second. And so that expansion has to be funded from somewhere, right? If the banks can't fund the expansion on the asset side from deposits, what do? Well, you've got to either fund it from borrowings, which could be, hey, you issue a bond. Well, we're seeing, I didn't highlight this, but that trend is also tapering off. Banks are not tapping the bond market to fund that growth. What they're really booking it out of is this other or trading liabilities, which think about it as a pass through, how this would work in practice. Not an expert here, talk to a professional, but this would come not in a security form. This would be counterparty funding, right? So it could be you borrow from a counterparty. Maybe you pledge so a collateral, security, et cetera, with another financial intermediary, a counterparty, interbank lending in the money markets. That is becoming the funding source that's really been ramping up. If you follow the trend here, 0.5% contribution to growth a year ago. You can see it ramping up. End of July, 4.7% or 3.9%, depending on which week you take. 7.3%, August 6th, which kind of the red bars are high. Like I set them there because those are where the results and on that distance of look back window, they're really starting to look like stable trends in my mind. But if you look in the most recent 2 weeks data points, we have 5.2% from other trading liabilities in terms of funding. And then August, that last 1 week, up 21% or 21.1, which essentially means if you look at the asset growth here, which if banks expanded in that 1 week from August 20th to August 27th, for all 52 weeks, you'd see 22.8% growth in the aggregate balance sheet of the commercial banking system. That's not sustainable by any means, but 21.1% or 21.1 of those percentage points would have funded 22.8 or essentially like 95% plus of the growth in terms of contribution from that source. So not sustainable very clearly, but it really goes into what's going on in the funding markets with the large banks in these global money centers, London, New York, Tokyo, Hong Kong, et cetera. They're really funding it through counterparty relationships between themselves. So interesting things going on. We'll try to make sense of that with what's happening here. A little bit of finance 101, or this is definitely not a 101 topic you would learn. Maybe 301, 401
I was gonna
type
say
of
in
stuff.
school it's definitely EMH all day, every day. There's no deviation.
Yeah, which is very simple, right? It takes no work. You're just like, oh, everything's efficient. It's worked into the prices. You don't have to do that much intellectual thinking or energy expenditure to develop an idea of what's actually going on versus maybe the liquidity theory money is a bit more complex, and also you can acknowledge that EMH is directionally correct over the long term, but it doesn't give you a kind of a mechanism for explaining how price discovery takes place and finds their correct levels or trend toward their correct levels or intrinsic values, or as some of us would describe. So anyway, just a background. This book was written. It was published in 1994. It was basically the lifetime of work from a practitioner. This guy Gordon Pepper. He used to be known as the guru of the gilt market. If you think about gilts, you might have heard this term to describe United Kingdom government debt. They just called it gilt or gilt-edged debt. Just the name that stuck with them. But I would credit this to, or I would chalk this up as kind of forgotten knowledge that deserves to be uncovered and redistributed for understanding of the bond market, currency markets, and then asset prices. It's basically, in my opinion, a much richer framework for understanding what's going on when you don't have that crutch of just oversimplifying, lean on the EMH during a 30 or 40-year bull market, which is basically driven by the largest secular expansion in money and credit and possibly human history. So when your old model stops working, or your crutch model stops working, you need to go back to the old, which the wise have already discovered for you. You just need to go back and learn it, in my opinion. So Let's get started there, Cameron. You ready for a little bit of a deep dive?
Absolutely.
All right. So the basics here, if you think about it, asset prices are kind of a function of what's going on in money and liquidity, hence the title money, credit, and asset prices. And on a credit money standard, which the entire world has been on the global dollar standard that really uh, took off in terms of like a rapid expansion really in the 1970s. Um, More credit equals more money equals higher asset prices, which is kind of the experience all of us have lived with throughout our working professional lives. Um, so the basics here is the business cycle, the monetary cycle, and the credit cycle. They're all kind of um, part of the same thing, right? So to just anchor this in to drive a nail into the wood, if you will. The basics here are that in terms of business cycles, bond prices will reach their trough, which means yields are at their high shortly after the boom turning point of a business cycle, right? So what does that mean? During um, uh, during the boom, bond prices will reach their high. Well, you'll get the lowest yields is kind of consistent with the ramp up in business activity. What does that mean? It's counterintuitive if you think about it. You'll actually see the fastest rate of growth in businesses once the inputs to their role as transforming capital and labor into some finished good or output or service into the real economy. You'll get the boom when the price of money is low and there's going to be a heavy demand from business or an impulse in demand for finance or credit from the financial sector of the economy from businesses. And at the same time, you'll typically see labor prices low. And I'll get into that with what we saw with the results for unfilled vacancies. And hopefully this will all start to click and make sense if I do a good job explaining. Um, so the boom is actually synonymous with interest rates bottoming and bond prices peaking, if that makes sense. And then the peak of bond price, or sorry, yeah, the peak of bond prices, sorry, or low yields usually happens at the trough of the recession. I said that backwards before.
Hard to keep in
Bond
sync.
prices will reach their trough or yields are high um, after the boom, right? Which means you've exhausted all of the demand for financing. Then you're done. Yields can't go up anymore. Um, you'll get at the recession or the trough of, or sorry, at the trough of the business cycle, you'll get a peak in bond prices, which means low interest rates. Hopefully, I did that I botched that, and it's just like this is kind of what I was talking to Cameron about in our initial show review. It's counterintuitive if you think about it. Like these things are flipped if you think about it in terms of where yields are, highs or lows, versus where the business cycle is.
Right.
That's the starting point. Cameron, you
Yep.
still with
And I
me?
think just for my like in my head explanation right now, it's right. It's separating the general vibe in the US, right, from what the actual markets are doing. So if you look at '08, obviously you could start to kind of draw that line saying, okay, the trough of the recession was actually, 2010, whatever you want to say in terms of exact date. Draw the line up to a peak, but you probably wouldn't put the but you would also line it up with kind of where the uh, rates were dropped as low as possible, right? They're trying to then accelerate back
Yep.
out of that, and then obviously to this point, that's why you're getting that kind of mismatched kind of set of ideas. So in my head, it is still straight, but explaining it in words takes a little bit of thinking.
Yep. And I think most people don't think in this framework, kind of myself included. This wasn't part of my undergrad or master's education or CFA curriculum. This isn't drilled into you, so you really have to think about it, and it'll slowly make sense, the liquidity theory of money and asset prices. So yeah, just a foot to where we are today. I showed on that slide of the 10-year Treasury, yields are coming in, right? Bonds are getting bid, which is it is synchronous with the second half of that orange underlined sentence. The bond prices tend to peak shortly after the trough of a recession, right? So peak, right? Yields are coming down, right? Yields are going to keep coming down until you get to potentially the recession. Now, does this mean a recession is in our future? Is it a nominal recession? Is it a real recession? Um, those are all different idiosyncrasies that we have to address. But the key thing is this is synonymous with a slowing market, and we'll get into what the jobs numbers say and what the JOLTS numbers say for unfilled vacancies. That is synonymous with this framework, and hopefully we'll give some explanatory power on what might be in front of us. So this last sentence here, combining the three market, he talks about bonds, equities or risk assets, and property prices. So there's a clear tendency for asset prices to rise as a recession develops. All right, so that's literally what we see going on right now. Bonds are up, equity prices up, property prices up. We can include in property. It could be real assets, farmland, residential real estate, Bitcoin, et cetera. Those prices are up, right? They tend to rise as a recession develops and then eventually fall as the boom is approached. So we'll just focus right now. Everybody talks about right now, is this recession ahead of us? You see the job cut or the job disappointing non-farm payrolls numbers, the JOLTS numbers, which are declining, maybe stagnating, but the rate of change is down, potentially flattening, negative first derivative, positive second derivative back in the calculus terms. That's synonymous with where we are in the cycle right now. So hopefully that gives you a good point on that map framework with the little star, you are here. This is a good outline for where we could be or where we likely are in terms of positioning ourselves on the map of business cycle, monetary cycle, fiscal cycle, all of that. Hopefully that gives a little bit of perspective when we put that star on the map for you. All right. Next slide here, just going through some other key points in this textbook. So this is a mechanism or a mechanical explanation of what's going on with interest rates as you're going through that process, right? As bond prices are increasing towards the peak towards as you're heading into the trough of a recession, right? So what's going on? Late in the business cycle, so growth is transforming towards slowing growth, which may bottom out. If that growth number bottoms out at positive, maybe you don't actually see a recession, the economy just slowed and then ticks back up. Or if you go into an actual contraction, right, the economy starts shedding jobs, taking capital losses, credit losses, et cetera, before going through the trough and then experiencing the next boom or growth trajectory. We're in that cycle, part of the cycle where we're moving from peak of the business cycle towards a trough. And this will walk through what's actually happening in interest rates, right? So interest rates tend to fall as we move on that part of the curve. And what's happening is people get used to, people and firms, right, get used to the income that's derived on money and their savings when rates are high, right? And we talked earlier about high interest rates tend to be synonymous with the boom, right? Bond prices tend to reach a trough after the boom. Low bond prices, high yields. Savers come in, they get used to the high levels of interest income. They enjoy that, right? And if you think about this, During the boom, 2022, 2023, interest rates were at 5.5% at their peak, right? People got used to that. They liked it, where no risk from their, no nominal risk from the financial system or academic framework, investing in T-bills or money market fund assets. You get used to those earnings or that income level at a 5.5% yield. You build your consumption patterns around it, right? You take your trips, you do your financial planning, you may buy other assets, but you become used to whatever lifestyle that level of interest income or yields allow you and everybody in the economy to obtain. Um, so that, and also here during the peak of a boom, you also tend to have that experience, which was highly drilled in the financial media, the inverted yield curve, right? You got 5.5% front end, and let's say a 4% or 4.5% 10-year or 30-year Treasury bond. You actually have an inverted yield curve because um, there's so much capital that's pulled into the front end of the yield curve. People like that 5.5%. It tends to be associated with the inverted yield curve, which is what we saw from 2022, 2023 into 2024, but that's normalized in terms of positive slope. Um, so as the term structure of interest rates reverts to the positive sloping yield term, private investors then respond by shifting out of money markets. They were earning, let's say, 5.5% 2 years ago. Now they're earning 4. They can see the trend, and they know, you've been drilled in for multiple months now in the media. If you're not aware of it, the federal Trump argument with the Federal Reserve, lower rates, that's part of the process of the system pushing rates down. Doesn't matter how we get there, right? And this time the narrative was Trump is beating up Jerome Powell to do so. It's been 3 or 4 months of that. At this point, um, they have the common motive and the reasoning with the purported slowdown in non-farm payrolls and job creations in the economy. They see the unfilled vacancies in the JOLTS market declining, maybe bottoming out, but definitely on a downward trend since 2022, 2023. So they've kind of prosecuted their case. They think they have the kind of the reasoning to obtain that conviction, to put this in legal terms, to get those next round of rate cuts in. My point here is the private markets, businesses, and households have seen it coming. They've had ample time to prepare. It's been telegraphed. And what you're seeing, and including the financial sector, the banks are doing it too. We talked about it in the H.8 report, where we're seeing cash assets extend out into treasuries. That's why I talked about this. You are seeing these investors respond to what's been telegraphed as coming by switching out of bank deposits into longer dated securities in an attempt to preserve that income. Now, what comes next could be, as individuals keep trying to preserve that income, they may actually come to realize, hey, I need to take on more risk. It's not just adding duration. Maybe instead of going from a bank deposit to a 5-year treasury bond or a 10-year, or, oh my gosh, a 30-year treasury bond. Have you seen what those things have done over the last 5 to 10 years? Instead of doing that, they may extend more credit, like they may go into corporate bonds, or they may go into high yield, or they may even go further out on the risk curve and buy more equities, buy more Mag 7, um, buy more Bitcoin from the systems legacy framework. I know if you talk to a Bitcoin maxi, they'll say Bitcoin is the safe thing. Stay humble, sack sats, right? But from the liquidity and money standpoint, if you're taking this from the deposit-based banking systems view on money, this is how households, businesses, and governments are responding to the underlying trend, the business cycle. Does that make
It
sense,
does.
Cameron?
So I mean, I even see that. I'll talk my own personal account really quick here. We've my wife and I have had some money in a high yield savings account just sitting there because why not? But now, as exactly like you're saying, we're considering, how do we want to move that around a little bit. So even at the micro level, this is playing out.
All right, awesome. Hopefully, glad this made sense. This is one of the first times I've tried teaching this, so it's not as Chris if you've seen me on other podcasts, but this is kind of the first attempt, and we'll keep drilling through until we're really good at pitching this. All right, so this is the last slide from the 1994 textbook, so you're done looking at old black and white charts. I added some pink highlights here because the graphs were very hard um, to differentiate for me as I'm reading this on my Kindle. The only way to get this book is like old PDFs. You can't find the physical copies anymore. This isn't something you can go on Amazon and order. And old textbooks didn't have color for the most part, so I tried to add it. But these are just three slides I pulled out that go through um, just establishing the proxies of what's going on in the real economy and then how it impacts bank deposits we talked about these on the liability side. That's how banks fund themselves. And then on the asset side, bank lending, and then specifically government debt purchases, right? So I'll start with the two in the pink on the right. So on the two right charts, you see that the pink line I've highlighted. It's the same line on both charts. It is the unfilled job vacancies numbers. And these are coming from England, right? This Gordon Pepper guy, he's from the city of London. He's not US based. So he's taking a UK perspective on all of his analysis. We can port that over onto, there are minor differences in structure. Not say beyond minor, like there's a lot of differences in structure, some of them major and significant. Um, but it can be a good proxy for the same framework on a deposit-based credit monetary system. So this unfilled jobs vacancy line in pink, your analogy for that in our framework in 2025 is this JOLTS report, right? That's your unfilled vacancies. These are the jobs that this report from your government bureaucracy is saying these are the jobs the private sector and government sector want to hire. This is where the demand for labor is, but they're not filled, right? So that number, the stock of jobs, the demand for labor input as it moves up and down is there's some degree of which one is causal on the other, and that's where you get into some research reports here. We won't address that today, but it very closely proxies on a lag and a lead when you look at on the top chart is bank deposits, and then on a lag, bank lending, right? So if you think about how banks are adjusting the amount of money in the economy, it's coming through the savings channel in terms of demand for deposits. And then on the demand for money and finance from borrowing on the asset side, bank loans, leases, treasury bond financing, that stuff, all that stuff we went over in the H.8 report. This is kind of what that tends to look like over the long term in a kind of a textbook case, if you will, in the UK. And this is going through the inflationary period of the 1965 to 1981 window that we're all very familiar with at this point. But you do see as the job vacancies kind of boom and bust in the economy, bank deposits and bank lending tend to proxy that, right? So there's something going on here. If you think about where we are right now on the chart, I'll try to think about this in terms of, all right, unfilled job vacancies, demand is declining. This little stretch right here, if you think about this path from 74 to 76, unfilled job vacancies declining, businesses having less demand to hire. That's kind of where we've been at for the last 2 to 3 years, right? And then, so if you look at what tended to happen, at least if you carry forward these correlations, um, that would be synonymous with deposit, um, a slowdown in the rate of change of deposits, right? And that's kind of what we're saying on like the 1 year look back, right? Job vacancies coming down. Eventually, your deposit base growth will slow down, right? You started with an impulse, now it's coming back, hits zero. Then you start contracting once you go negative. Um, Deposits contracting is not a good thing in the banking system. This is where if you're a regulator, you're setting interest rate policy, you want to stop that ASAP, right? Because you get the classical Achilles heel of a deposit bank, fractional reserve funding model is the run on the bank. We've known this. Everyone has known this for thousands of years. You cannot let that happen as a bank regulator. So um, you have to adjust interest rates and monetary policy basically to prevent that tail risk outcome from happening, full stop, right? You'll see the same thing happen with bank lending on an even larger lag. Banks will uh, throttle or slow down their pace um, of lending on an even kind of a wider lag, 2 to 3 quarters. This will show up even before the deposits tends to start kicking in. But banks will slow down their lending, which is also going to naturally trigger that slowdown in job vacancies, right? There's less demand for financing at current interest rates. Uh, Demand for money slows down, and then also commensurate with that, demand for labor slows down from the private sector and governments as they just slow down in the economic cycle or the business cycle. They're not producing as much output, which means both of those two key inputs go down in terms of demand. All right, and then to make the kind of the rubber hit the road, what goes on in treasuries, right? On the left chart here, you've got bank sector holding of government securities and also the price index of those said securities. So price index moves up, it means yields coming down. Um, and so what can happen, and this happened in the British case or the UK case of that this period we're talking about, 1965 to 1981. What was observed by academics and practitioners was during that same process. You talk about writing. I talked about that period, 74 to 76, where we saw unfilled vacancies coming down, um, bank lending coming down, deposit growth coming down. You also tend to see an uptick in the demand for government securities, right? And then also price levels of those government securities also tends to go up as that trend, those two trends start to play upon each other. So you go back to that H.8 report. This is exactly what we're seeing over the trailing 1 year. So I guess my end point here, it really explains where we're at, hopefully, in the business cycle. Everybody's like, how can a recession be coming? Asset prices are high. Well, this is what they should be doing based on the liquidity theory of money and asset prices framework. Um, and it also doesn't mean when we get to a recession, doesn't mean it's going to be a negative nominal recession. It may just be, we may just still experience positive growth in the economy on a nominal
A little
basis,
slower.
right? Which is measured in nominal dollars, right? So the amount of money moving through the system may still, proxy towards positive growth, but in terms of real terms, you may actually have a real recession or that bottoming out process. None of those lines or neither of those lines might, may cross the zero and ever tick negative. We don't know until we get there, but we are on that path right now where we're trending towards a topping and then a downward is what the data shows right now. Now, how deep is that trough? Is it 2008 or 2020? It doesn't have to be. It can be shallow, and if we do the right things, we step on the gas, we pull out of it, and that's where you see, as we talked about, some of these indicators we see, like low oil prices, OPEC stepping up production, dollar low. These are things that are being executed on to try to reverse that tide, basically reverse that trough from, where does that lower low take place in terms of economic growth? Where's the bottom of the business cycle? The Trump administration, and then in cooperation with other partners, both domestic and globally, right, are really stepping on the gas or taking actions to keep that low from the trough standpoint to be as shallow as possible. That's what they want. They've said this. They've said, hey, we want to run it hot. We want to do X, Y, and Z to ensure that really at the end of the day, it's to make sure the fiscal situation doesn't get any worse, right? Don't do no more harm at this point is kind of the mission objective of what the Treasury, in my opinion, is trying to accomplish.
No, that helps put all that in perspective. And I think, I mean, your comment on the oil production piece too kind of pulls in. I saw, I believe it was Saudi Arabia, right? So they're going to increase production, right? So at the time, I was kind of sitting there going, that doesn't quite make sense if oil prices are low, and you're starting to see kind of threads pull together when you put the right framework behind everything.
Yep. It's very clear they're cooperating. If they weren't on friendly terms with this administration, they would be saying, "Hey, no, we're going to curtail production and try to drive oil prices higher," which they could very well do. But it shows a sense of cooperation between this administration and some key administrations throughout the world who may not have been on as good or just positive in general terms with some of the key players on the global economic stage over the last or the prior administration 2021 to 2024 2025 when that handoff took place. So really gives you a data point where some of the biggest parties and players in the games, their actions start to make a bit more sense if you think about it in the liquidity theory of money and asset prices framework.
Oh, that's huge, and I think we're probably going to have other pieces we'll want to come back to within this book. Not sure, but I know Matt, you sent me some snippets here and there, and I definitely have it on my to do list to read through all of that. So for our viewers, again, I think if you get a chance to get your hands on the copy, or reach out to us, we could try to point out some ways you definitely should read through the book. It's very very interesting.
Awesome. Well, let's get into the
I was gonna say,
SCO.
so speaking of, maybe different business partners, different international cooperation going on here, this is one that kind of popped up on my radar, and I know Matt, you, that's
Oops.
okay. You're gonna have a lot to speak on here, but maybe just kind of explain what's going on in this photo first off, because this is not something you normally see with these countries.
Yeah, let me see if I can clear that. I don't know how. I didn't mean to draw that. I thought I was going to drag a slide to look at these world leaders, but let's just go through here. Anybody we recognize? There's Erdogan, Modi, Putin, Xi.
I'm sure we're missing a lot here, but definitely Japan, right?
Yeah,
But yeah, I mean,
yeah,
basically all of the other countries in that kind of Asia, Indo-Asian area are in this photo.
yep, yep. So Shanghai Cooperation Organization, I think it started in the early to mid 2000s. Basically, it's an economic block, but also a like defense block. So if you think about what's an analog, like large treaty groups, NATO would be the biggest one if you think about it between the North American democracies and Western Europe. I would say this SCO, Shanghai Cooperation Organization. This one should be on front page news. If you know NATO, there's no excuse not to know what's going on with SCO at this point. So if you think about it, if we drew these on a map, what you would really see is the Asian continent itself, the giant landmass. Everybody on the landmass has now been kind of organized behind this entity, which is really led by China, I would say, hence the name Shanghai at the in the title. Um, but this meeting just took place this last week, and this is where the massive developments are taking place, in my opinion, on the realignment from a unipolar to a multipolar world, right? So I think I'll open up. Cameron, you have any questions there or comments there? Big things going on, but this SCO meeting last week, this is something that probably deserved a lot more coverage than it's getting in Western
I think
media.
my only
Uh,
comment is, first off, I agree. There's been very little coverage. I think I've seen memes, frankly, online of just I think there was one with Modi and Xi and Putin walking together, and just a lot of comments on what language do you think they all speak when they talk to each other, things like that, but not any not very deep analysis on, what does this actually mean? How does it actually change, the power structure across the world when obviously that's happening. And then the second thing I would say is, that I think we need to be watching what is going on with how Trump and kind of the U.S. is responding to some of this, because there's a lot of folks here in the U.S. as well that even I speak to that kind of say, well, I don't get why there's backtracking on this or that, or I don't get why this thing happened a different way than I expected it to, and it's because the world is changing. You're seeing different alliances forming, you're seeing different relationships happening, and this is part of what's going on.
Yep. Yeah. If you talk about, everybody tends to think there's a massive war coming, right? Well, it's going to be hard when you've got this type of consolidation and cooperation between the entire Asian landmass. The way I would view it is all of these economies now, which have tended to be historically very difficult to organize and cooperate amongst each other, as well as very difficult to build infrastructure because everything needs to be built on land, right? These are landmass countries with maybe ports on the outer edges, right? If you think about Southeast Asian countries or the Chinese coast, et cetera. The northern landmass is pretty much covered in ice and difficult to use as ports. That's where the Arctic lanes opening up potentially is a massive development in the decades ahead. But historically, these tended to be resource or viewed in the old model that's dominated for centuries. Colonial mercantilism. These have been viewed as resource countries. The resources are extracted, or their local labor is basically taken advantage of for obtaining manufactured goods at low prices because the labor doesn't have its ability, or the governments don't have their ability to push back and defend themselves and capture or defend more of that value within their own domestic economies. What I view this is basically now they can stand on their own. We haven't been at this period in history since the old Silk Road had been basically viable in Marco Polo's journeys, right? Basically at the turn of the last millennium. So this is a massive development that's ongoing. I won't get too much deeper into it than that, but gold, defense, everything like it's kind of where the action is happening on the global geopolitical front. I'll leave it there. But the key thing I think coming out of this is China and Russia um, executed a deal. Maybe not everything signed on the dotted line, but it's basically happening now. This Power of Siberia 2 pipeline that's basically going to connect the Russian oil and gas resources. So think Gazprom, all of those pipelines that used to be heading towards European markets as the final consumer. We're seeing with the Ukraine war, the destruction of the Nord Stream 2 pipeline, all of that, basically cutting off Russian access to the kind of the remaining G7 ex-China, Western European markets. We've now got a deal between Russia and China to build out the infrastructure, highly capital intensive, all of that, especially what's going on in finance and money and since 2022, right? But basically, they agreed they're going to build this Power Siberia 2 project to connect the Russian oil and gas resources coming out of the Urals, Baku, etc., and cut through Mongolia and essentially bring those natural resources to the Chinese coastal markets as the ultimate source of demand. So I think this is something that's not showing up on the front page of Wall Street Journal and Financial Times, But this is truly a massive development in global energy markets because if you think about building an economy, right, you start with affordable energy access, right? And this solves two things, solves important problems for both Russia and China. China in terms of access to dependable economic and cheap energy resources in terms of Russian natural gas, and Russia as well in terms of an end customer, right? Because ultimately your barrels and British thermal units in the ground are, you know, useless within an underdeveloped or developing domestic economy. It's not fully industrialized unless you have a buyer or a consumer on the other end of the transaction to to uh, to to finance your own economic growth. So huge development here that took place at the SCO summit, particularly at the energy layer of the global economy. You might not have heard a lot about it in the past, but I think this is truly massive. And essentially, the other repercussions here are in terms of Western Europe for energy supply. At this point now, you're going to have to compete with China, right, as a buyer, and maybe China will underprice you, but they're also a friendlier customer, right? I don't think you're going to have to deal with the Xi Jinping government or his successor blowing up this pipeline infrastructure that say your domestic economy has invested in. I think China and Russia tend to be on much better terms ever since the fall of the USSR. And that kind of conflict ended and has entered a new era in Russia-China relations, which, by all outward observations, from my perspective, China and Russia tend to be getting closer and closer together. As well, you could even add to that, it looks like India is also kind of becoming a friendlier relationship with those two countries as well. So the real risk here, if I'm looking at this deal, you got to question Europe, right? If you're Western Europe, where is your energy supply going to come from, right? Essentially, your other market. Well, do you look to other Mediterranean oil and gas production? Do you look to you could always go to the Middle East, of course.
Middle East,
You could look at
Africa.
North Africa, but really for any incremental demand like LNG, you're probably looking at US, right? So very interesting development going on. Has geopolitical repercussions, but basically this is to me it looks like don't fade the integration that's coming from that's really coming on the tape of this SCO summit this past week.
And as we talk about the energy piece, I think, and broadly how that impacts Europe, I mean, our last topic of today, what's going on in France specifically? I mean, I did a little bit of research on this over the weekend, and I thought, there's a lot going on in France that I just was not fully aware of because, again, it's not, talked about much on US media, but this is certainly making headlines right now. Matt, what does this mean with Macron's bloc? I believe actually the prime minister this morning was ousted. So, what does this mean for France?
Yep. So about 2 weeks ago, it started showing up that the French prime minister uh, was basically going to call a no confidence vote in the French Assembly. What does that mean? It's basically a thumbs up, thumbs down. Can we get a budget passed? If the parliament or if the assembly says no, it's basically like, well, we're back to the other options. I'll go with those could be. But if you think about this, if our audience is primarily US based, think about the process we went through for the one big beautiful bill, right? You've got to go through, you've got an executive branch. He has to cooperate with Congress on setting a budget. If you don't set a budget, the government doesn't have an operating platform for the next year. So you basically have to get to a consensus, right? And in the U.S. case, was it really that controversial, like getting the One Big Beautiful Bill Act through? I mean, there was some minor, complaining. Of course, the opposition party said, "Oh, this is wasteful spending," as every opposition party does every time this process happens. There were a couple of we call them flip votes from the Republican side in Congress that made it somewhat close. But in reality, it was a pretty straightforward big win, if you will, for the Trump administration to get that one through. Not too much conflict or disagreement in the big picture in terms of getting it done. Now in France, it's the opposite. It's you've got a split National Assembly. If you recall the election, I want to say it was July of 2024, but don't hold me to that. We can go back and look at last election. But the key event in that, the loser, as it was described, was President Macron, who basically lost a governing coalition, and you had a split faction between conservatives, or what you'll hear in the media call the far right, the centrists, and then the left or progressives, if you will. So between all of those parties, there was basically no governing coalition, and this is where the difference in the democratic structure between a two-party system or rules-based structure that organizes towards a two-party system where consensus is much more solid and robust versus kind of the French model, or you'll see this in other democratic kind of frameworks where it encourages broader coalitions, a multi-party model. This is a core problem of that. We talked about Achilles' heels right earlier in this episode. This is basically what the process gets to. You can't get a budget passed that everybody can agree on and strike consensus. So basically, what the Barrier budget asks for is like getting ahead or solving the French budget problem, right? And in terms of deficit to GDP on the public side, it's like 5% debt, fiscal deficit to GDP. It's not even as bad as it is in the U.S. It's just the U.S. could get the budget passed. They're gonna spend the money, do the balance sheet expansion, absorb the repercussions that come from that, all the above. In France, there is no political consensus, even though that 5% number deficit to GDP isn't as bad as in the U.S. They like the political process is just incapable of delivering that result. So now that we have the no confidence vote on the record, basically Macron is going to have to find a new prime minister from the ranks who can hopefully build consensus. So you've basically got three things that can happen, and this is coming from a call I sat in on with Goldman Sachs and some experts who are involved in this process. So number one, Macron names a new PM, and the government is able to produce a new budget. Move along. Like that's the best option. Number two, government names a new PM, but the budget can't get through Parliament. We're kind of in the same scenario, and you just work through this through chaos. Or number three, the president calls a new election without going through this new government. We're going to start over and see what the people want. All of these things entail political risk, right? You've got this background underlying where it seems very clear if you follow the headlines, you follow the unrest, what's going on in large developed Western European democracies. You go to Germany, Netherlands, France, UK. They very clearly, there is a forming kind of tract of the population or the voting electorate who wants to move right or more conservative. And the natural pushback is you can see it in the media. Any conservative movement is kind of labeled far right. Like, where is this going? As Western Europe, they tend to be very worried about, you always fight the last fight, and
A
the
very strong
direction.
historical reason. Yeah.
Yes. In the 1920s, 30s, and 40s, we saw what that direction went. So there's a natural immune system response to that happening, and you can very clearly see it in the media. But so far, like, if you want to think about it, like, think about this in terms of like Darwinian evolution, as adaptation wants to move towards a steady state, or you can think about it in markets. This is the same thing happens in price discovery. This is kind of the way I think about it, is like the population, the electorate is telling you which way they want to go. Um, The legacy institutions or the incumbents are, applying new and uh, just ever increasing roadblocks to try to keep it from going that direction. Um, and one example of that is, you remember what we saw earlier this spring, Marine Le Pen, the leader of the, I call it the French far right's leader. I forget her party name, but that's if you think about what's her party. Oh, it's the far right. Um, Back in, I want to say this happened in March or April. Um, um, Marine Le Pen was convicted for accepting funds from the European Union or the EU Commission. Like they had EU members of Parliament in the party. They took funding in terms of grants or budget to hire headcount. Essentially, they used those headcount. The party used the headcount on the ground in France, which is where they were. That was deemed a no. They got her on that one, and she's convicted and barred from running for the presidential election the next time this takes place. It was kind of in my view, another one of those defense mechanisms. Well, if we know this political process is coming, and eventually, you know, this the French voters basically chose a split assembly with a very weak governing consensus. Once we get to this budget process, well, we know the direction it's going to take. We're not going to be able to get it through. Step one, like the action ahead of this, was actually what we saw happen with Marine Le Pen in the first few months of 2025. Now we're going to play through this process and work towards that next outcome. Is it, which of those three options is it? Do we get the new PM and does the budget get a government produce a new budget? Yes or no? Or do we get a new election? Um, my argument, the insiders already know the way they want this to go. They've already just been guiding the process towards that eventual route. But why I called the first image and the triptych panel, we use to start off every episode of the weekly roundup. Um, this is the catalyst, right? Barry calls the no confidence vote. It's not going to win, right? You know what the result is going to be, and that kick starts this process that is ultimately going to lead, in my opinion, to an outcome that's highly probable or known in advance. Otherwise, you wouldn't do it or operate this way. But basically, it's that you need that catalyst in the reaction to take the ingredients in a chemical reaction from the inputs to their end state. And that's kind of what I view we've just seen with France. And my kind of outlook, it looks like there's something that needs to happen now in response in the European Union. Basically, if you think about it, US passed its budget. We're good. Like our work is done. SCO just did what they did. Asia, the Asian continent, just did what they did. That was their move. Next move, the buck is passed to the EU. I think there's, something happening or something on the horizon there, and I think we're working towards that. And I think the narrative is likely to play out um, in the coming weeks, months, maybe quarters. But it looks like there's something on the horizon. We're starting to see it in bond markets. We showed the 10-year, yield coming down since January. It's been the opposite in the EU, right? German debt up, French debt up, UK debt up, something. UK is not EU, right? But basically same region, right? So you can see it in debt markets. They're providing that signal, and this is kind of the next step to watch. We're not insiders, so uh, we don't have the playbook in front of us, but we're trying to, stay in front of the headlines, read between the lines. So this is something we'll probably be talking about in the coming weeks on our roundup episodes.
No, absolutely, and we'll be watching this closely. So yeah, thank you again, Matt, for walking through for our viewers that deep dive on kind of bank liquidity, how that all plays out in markets, especially from that Gordon Pepper book. I'll make sure in the show notes I include the name of the book as well, so people can look for that on their own. And then again, thank you again for sticking with us through today's extra long episode. I know a little longer than our normal ones, but we are trying to catch up a bit from previous weeks where we've been missing a few of these episodes. So we are planning on recording again later this week with another weekly roundup. So stay tuned for that. And again, share and like if you like the videos as you see them up on your social media feeds.
Thanks.
See you next week.